it's funny when you said it's not necessarily something that someone knows or important in their day-to-day lives. It's actually a little bit of a controversial metric as well.
Welcome to Business Refocused, a podcast about the people, decisions, and strategies behind building a successful business. Each week, we talk with leaders and operators about what they're learning, what's working, and the challenges that come with growth. I'm Lindsay Sexton, and I'm happy to introduce you to my co-host, who just so happens to be my mom, Carey Wallace. Let's get into it. Hey, Mom, how's it going?
I'm having a good day, Lindsay. How are you doing today?
I'm doing good. I am looking forward to trying something new today. I listened to this other podcast, which is really funny. I actually listened to this podcast. We were batch recording the other day, and I listened to one of these podcast episodes in between two of our recordings, and I put this time on our calendar because the podcast I listened to started doing 10 to 15 minute short episodes that like deep dived into one specific thing. They call it bathroom break. I don't know that I need to go to the bathroom with any of our listeners, but I would definitely get coffee with them. So I figured we could call it coffee break. So looking forward to doing a little coffee break and diving deep into a single topic today.
Yeah, I love that idea. I agree with you. I'm not sure that I want to take a bathroom break with anyone, but I would have coffee. I might even do like a toast, like we'll call this either a
Happy hour.
a quick
Yappy hour.
drink or a coffee hour, like on your way to that, just a little quick hit. Absolutely. I love it.
Yeah, cool. So, I figured the best thing to start with was EBITDA because
Yeah.
that crazy little acronym that, um, is really important in the work that we do, but is not necessarily important in like the day to day, right? What does it mean? How do I calculate it? And why the heck should we care about it? So I'm gonna kick us off. EBITDA. How is it spelled? EBITDA. And what does it stand for is earnings before interest, taxes, depreciation, and amortization. And basically what that means is EBITDA is your operating profit.
That's
Right?
correct. It's actually it's funny when you said it's not necessarily something that someone knows or important in their day-to-day lives. It's actually a little bit of a controversial metric as well, because some people say it's not as important as it is. Some people say that it is, but in our industry, knowing the value of your agency, if you know this number and you can manage and maximize this number, you are in the driver's seat of positioning yourself to run your business like like you're selling it tomorrow, and also in a pretty high negotiation situation. So in our world, it is an incredibly important number. And in order to calculate your EBITDA, and I will also say that some people say it weird. I've heard it pronounced in a
EBITDA.
million EBITDA, whatever. I don't know if it's like my accents or my whatever. We say EBITDA, you say EBITDA, whatever. Like that's totally fine. But same thing. If in order to calculate it, you would look on your profit and loss statement or your income statement. There also are two names for that. The reason it's profit and loss is at the bottom of that statement, it will tell you your profit. And on the statement itself, it'll actually use all of the income, all of the expenses in order to get to that profit and loss. We're going to start with that bottom number. And if you think about it, we're going to put it at the top, and we're going to start either adding back or subtracting from that number in order to get to your EBITDA, which is we would add back any interest that you're paying on a loan. Let's say you bought an agency and you have an outstanding loan to pay off that book of business, or you might have a producer loan in place. You might have a loan for the building that your agency owns. You could have a loan for lots of different reasons. And any interest payments that you're making related to that loan would be added back because that's not a true operating cost. It's something that is part of your satisfying your liabilities. So we would add that back. Taxes, if you pay taxes, if you run a profit in your agency and you pay the IRS and your state taxes based on that profitability of your agency, again, that is an additional expense that you have to pay, but we would add that back for your EBITDA. It's important to note with that one in particular, the bank actually leaves the taxes in there because they want to make sure that you can cash flow paying your taxes, et cetera, when they are determining your loan for buying another agency. So sometimes that is whether it's included or not included. For EBITDA, you would actually add back those taxes. If you have something that you've purchased and it has a life according to the accounting rules, and you're amortizing it over a period of time, and you're taking that expense each year as that amortization dwindles down the life of that asset, you would add back that expense. Again, that's an accounting transaction on your P&L, and that expense is not an operating expense. And the last one would be depreciation. Same thing. If you have a fixed asset of some sort, lots of different things that you could have. You could have a car, you could have computer equipment, you could have a leasehold improvement that you've done in your agency, you could have furniture, you could have whatever. You have some kind of fixed asset that you're depreciating over a life and you're taking that expense over a period of time, you would add that back. You actually would also look at your owner compensation. So those are all for the acronym, knowing what's going to happen, right? You would also look at your P&L and your owner compensation based on your philosophy on how the owners are paid inside your agency. You might add back or subtract in order to get to what the reasonable expectation of what that owner compensation will be. Here's where things get a little dicey because you have to use some reasonable expectations, but there's ways to find what that is. So based on the owners that are there, they can pay themselves in W-2. They can pay themselves in distributions and sharing in the profit of the agency. They can pay themselves through the rent that they charge the agency if they own the building. Lots of different ways you can have compensation running through your P&L, but getting that to a reasonable amount of what that role should be and what a typical CEO of a business that size in your area should command is one of the ways you can figure out what reasonable is. It also could be, what would you need to replace that owner if they were no longer in the agency? If they're a producing owner and you had to hire a producer, what would that be? If they are in operations only and not doing any production, what would that be? So you have to, that's the reasonableness thing. And you've got to include that because in some agencies, they don't pay themselves anything in W-2. It's all distribution, and that would distort what that true profitability would be. And then the other part that you should think about with EBITDA is we all know that there could be discretionary expenses going through any business, and you have to remove those because that is really not part of running the business, selling insurance, running that agency. You might have some discretionary expenses in there that is a tax strategy for you to minimize your taxes in a legal and reasonable way, but you're putting some discretionary expenses through there. You want to add those back because you really do want what a realistic profitability of this agency could be if that wasn't your tax strategy. And the last thing would be if you had one-time expenses that occurred in this year. Maybe you're changing AMS systems. Maybe you've rebranded the agency. Maybe this was the year that you're going to refresh everybody's technology. Or you might have had just a single project. I had one agency, they did a 100-year anniversary and they threw a big party and they did all kinds of stuff. Well, they're not going to do that again for another 100 years. So that would be ridiculous to leave that in their P&L. So
Yeah.
those one-time expenses also get added back. And then you now have your EBITDA. So
Yep.
hopefully that's helpful, right?
I think it is. And how I like to, explain it to agencies, like why using an EBITDA number is important. One, because you get to take a strategic look at your financials and really think like, okay, what is actually recurring? What is my business operating at? Um, but also it levels the playing field. So if you are an
Hmm.
agency in California looking at purchasing an agency not in California or wherever you are, right? It kind of levels the playing field to show exactly what it costs to operate this and takes out all of the unnecessary fluff that you have to run through the agency. So, is there any other like reasons why you would explain why you utilize
Yeah.
EBITDA?
So I love doing this exercise and actually getting to what the potential operating profit is for an agency owner. Sometimes there's a byproduct of, oh goodness, when I look at the discretionary expenses and I look at what this could optimally be, and I also know that I have the goal to grow or I have the goal to get to the next level, you also might, because you've looked at it a little different way, find the opportunity that you do have the resources to add that producer, or you do have the resources to invest in that infrastructure because you really hadn't looked at your financials in that way and totaled all of those discretionary expenses or all those one-time expenses. And now you can actually take a look and say, if I reallocated that differently for a year or two, what is the total impact it would have on my performance? So
Mhm.
doing that exercise can be pretty enlightening for someone that hasn't done it before and hasn't looked at their numbers in that way.
Yeah. Awesome. All right. Well, if you have another coffee break topic that you would like us to cover in the future, maybe something that you have heard about, but you don't fully understand, or you want to learn more about, want to hear about in some type of context, right? Shoot us an email. My email is Lindsay with an A, Lindsay at agency-focus.com, and we'd be happy to cover it. Happy coffee. Cheers.
Cheers.
Thanks so much for tuning in to the Insurance Refocused podcast. If you enjoyed the episode, please be sure to hit subscribe and leave us a review so you'll never miss us. Want to learn more about how Agency Focus can help you grow your agency? Head to agency-focus.com or email Carey directly at carey@agency-focus.com. If you need to get in touch with me, feel free to shoot me an email at lindsay@agency-focus.com. Thanks so much for tuning in. We'll see you next week.